Hi.
Hey, Ali, what's going on?
Sorry.
No, it's fine. I was trying to just make sure I can get it, and then my volume. I want to make sure everybody can hear me too.
Perfect.
Yeah. So how you doing? What's going on with you?
Living the dream.
Yeah. So I've been getting a lot of interesting questions, right? A lot of people are hyped. They was pumped up about getting on live and just seeing, just getting some information for the most part. So I was like, yeah, jump on here. Ali's gonna get us right. She has everything we need, right?
Yeah, I'm ready to
So
answer any questions.
yes. So actually, just to make it simple and easy, I have like a list, just starting from the beginning, just so
Perfect.
to kind of segue into each subject. But a lot of people want to know what's the difference between pre-qualifications and pre-approvals.
Yep, that's a biggie. Pre-qual is just like stated information, like your income, assets. Pre-approval is what you want, and that's when somebody like me, who is a loan officer that actually looks at your pay stubs and W-2 and bank statements and really has checked the boxes, so there's no surprises when you go find a house.
Okay.
So definitely get pre-approved, not pre-qualified.
Okay. All right. All right. Makes sense. Another great question was, what documents are needed to start the mortgage process?
Yeah, so it's going to differ from person to person, but
Mhm.
that's why I always like to get on an initial call before you submit an application so I can prep you what documents you'll need. If you're just a W-2 salary employee, then it's probably just going to be recent pay stubs,
Okay.
30 days worth of pay stubs and your last year's W-2. Now, if you're self-employed, it could be your last 2 years of tax returns. So it just kind of depends on your profile. And that's why the initial consultation call, which it can be like 10, 15 minutes, is
Mhm.
really important step.
Okay. Do you usually see people come in? I'm guessing, I'm assuming, would you see them come in when they're exactly ready or when they're just kind of inquiring about getting started or maybe just looking around?
Yeah, I think I say always say that it's never too early to have a
Mhm.
conversation. So a lot
Okay.
of people think that they're not going to buy for another year or so, and
Mhm.
they end up finding a house they love like that weekend. So you just never know. So it's never too early.
Okay, nice, nice. Another great question was, how does your credit score affect your interest rate?
Yeah, so obviously your credit score is definitely important, but with that said, if you have a 580 credit score, you can still get a mortgage. So don't feel like if it's you think it's too low that you're out of the running. There's definitely plenty of options out there, and that's another reason why I say it's never too early to have that conversation, because there could be things that you could do to improve that score so we get you to the point of home ownership, even 3, 6 months down the line.
Okay. Whenever it comes to the interest rate, I know you guys have programs. So is that something you kind of push for, or is it just a common thing to just go one route or one avenue to try to get everyone pre-quad in the beginning?
um yeah, I mean, I definitely think being pre-approved initially is the goal, right? So as far as the rates go, it could be different from the time you're pre-approved to the time you actually are locking in that rate. And when you're going to lock in the interest rate, it's going to be when you're actually under contract. So
Right. Yeah.
depending on the time difference, it could be completely different. And that's another reason why I tell people to let me know when they put in offers. I think that's another point of why real estate agents and lenders have such a good relationship and stay in communication, because that way everybody's on the same page. And again, there's no surprises. And when you're ready to put in an offer, we can update an estimated loan worksheet to give you like the numbers that are really accurate based on that day's rate. And not only that, but like the home specific, like taxes or HOA dues and that sort of thing.
Okay. All right, that makes a lot of sense. Um, Let me see. There's so many great questions I had coming up here. Can closing costs be rolled into the loan?
It depends on the loan.
Okay.
Normally they cannot,
Okay.
but there is a program that we do have. It's specifically an FHA program, and we can roll in some closing costs.
Hmm.
Um, and then I'm seeing a lot of seller credits. I don't know if you're seeing that too, but I
Yeah.
feel like a lot of contracts I've gotten I've seen a seller credit right off the bat, and
Hmm.
that can help, reduce your total out of pocket as far as closing costs go, because the seller can help offset that.
Nice. Okay. I know you mentioned programs. And was it FHA? I think you mentioned. Are there any other programs like people might be interested in? I know you're very savvy and you kind of, you make things work for people. So, is there anything
Well,
that you
there
recommend?
is not a one size fits all mortgage. If you
Okay.
talk to me, you've heard that before, but there really isn't. I think there's so many different options. Um, that's what we kind of explore after the pre-approval application has been submitted, and we look at all options and we kind of narrow down which make the most sense for the buyer's, needs and wants and everything. And then it can change even more so if the property is something that changes things, like if they fall in love with a property that just needs, some love and some, renovations, there's renovation loans that we can explore that maybe
Okay.
somebody didn't expect in the beginning. Or if, you know, they were looking at a property inside the city limits and then decided to go more rural, we can look at USDA options that finance 100%. So
Yeah.
that's like, again, like another reason why like the communication is so important, even when you're out there looking at houses, because things change and we can just go with the flow and
Yeah.
update anything as necessary.
Okay. Nice. And just kind of segue into the next thing because we were talking about the loans, but I know some of those loans are assumable, right? So
Mm-hmm.
some of these interest rates that are maybe like 2.5 or around 3%. Some people can come in and take over those loans, right? Correct.
Yes,
Okay.
that is definitely an option, especially when the seller has like a VA loan is usually like the most, um, popular one. You can assume a FHA. You cannot assume a conventional,
Okay.
but the only thing that comes up there is when that is available, what you'll want to do is look at how much the seller owes on their mortgage, because that's what you'll assume. So the loan amount versus the purchase price might be completely different and too far off, where that gap has to be made by either cash or a second loan. And that second loan is going to be a second lien, which is going to be likely a higher interest rate and different kind of terms. So sometimes it's great if the math works, but
Mhm.
sometimes it makes more sense to just get a new loan, even though the interest rate's higher, because the two loans might actually make your monthly payment
All right.
higher.
Okay. And when they come to you and they have that conversation, that's something that you would kind of just educate them on or make sure they're privy to.
Yep, exactly. So they'll want to know all of those numbers, and I can help them kind of figure that out, what makes the most sense. And
Okay.
then for whatever reason, if it does make sense to look into assuming the seller's loan, like the maths, then
Mhm.
they would just go to that seller's loan servicer directly. So if they finance it through, whoever, they would go directly through that company and check all the boxes as far as qualifying.
Okay, so if they were to go that route, you would be the one to hand. Would they contact the old lender, or would they just come to you, or how would that work?
Yeah, it would be the old lender that does all the loan qualification in that instance.
Okay, okay, oh, that's interesting. Okay, do you have any recommendations for anyone that is considering like refinancing, or I guess I've had some questions about the HELOCs, right?
Hmm.
About maybe pulling some equity out of their home as well. So I'm getting general questions like that too. Do you have any input on that?
Yeah, I mean, I think again, it depends on their circumstance and why they're refinancing. If they're
Okay.
pulling out cash, maybe it makes sense to do a cash out refi instead of a home equity loan.
Okay.
Again, if the terms are just the total payment, both payments is going to be less, or maybe they're just pulling out some and it's not a huge amount, so that second loan payment isn't going to be crazy, and they still will keep, if they have like a lower interest rate for their first mortgage.
Okay.
Um, there's so many different like home equity loan products too. There's some that are just closed end where you just get the cash and that's it. And then there's other ones that are more of like a line of credit, and you can, keep open and just use whenever you want, whenever you need.
Mm-hmm.
Um, and a lot of people just kind of have those for when it's needed instead of,
Emergency.
immediately.
Yeah. Yeah. Um, are they taxed on that when they put that money?
I am not a tax advisor, so
Okay.
talk to
All
your tax advisor.
right.
Um,
Okay.
but there are tax benefits for the interest that they pay on any kind of mortgage related loan.
Okay. Another great question. What is mortgage insurance and how does it work?
Um, Mortgage insurance is when you put less than 20% down.
Okay.
Anytime you put less than 20%, it's going to involve mortgage insurance um, with standard loans. The FHA loan program, though, will have mortgage insurance no matter what you put
What?
down. So if you put 50% down, you're still going to have mortgage insurance there.
Okay.
The there's there's a common misconception that mortgage insurance is just super expensive, and it changes the farther away from 20% down. So say you put 3% versus 15%, it's going to be more. So the less you put down, the more per month it's going to be. But if
Okay.
you put, 15%, it's not like that bad as far as the monthly payment. It just kind of depends on that sliding scale. And then it also factors in your credit score and your debt to income ratio. And then it's based off the loan amount too. So it can really differ depending on all those factors.
Okay. Like that. That's a conversation to have once you get to that point.
Yeah, and
um.
again, it's just one of those things where we show all of the options and different like loan estimates up front. So those numbers are really important, obviously,
Yeah.
and it can change your monthly payment, and that's usually what is the most important to the majority of the people. So
Yeah. Yeah. A lot of people are concerned about we're looking at the price of the homes, but they want to make sure that their mortgage is around a certain amount. So when you factor in all those things collectively, yeah, it really does make a significant difference.
mm-hmm, mm-hmm.
So I have a great question, JP, real estate. How much money do I need up front to buy a 300K house?
Well, it depends on how much you're putting down.
Yeah, absolutely.
But yeah, I mean, if you're a first time home buyer, you could put down as little as 3% with a conventional loan, or, FHA is as little as 3.5, regardless of whether you've owned in the past 3 years or not. So it just depends. And again, you can find like a USDA loan where you don't put anything down, or we do down payment assistance, and we can use the flat 15,000 for down payment or and closing costs,
Okay.
or the there's another down payment assistance where you do like 3%.
Okay. Another question: is it possible to have a no PMI loan without putting 20% down?
Yeah, and I specifically said because of like standard loans. Now there's like plenty of credit unions out there that don't do PMI even if it's less than 20%.
Mm-hmm.
We also have like some brokered loans that are just kind of like non-traditional type of loans that don't have PMI. We even have like a jumbo loan that does
Mm-hmm.
not have PMI, but the minimum down there is 15%.
Okay.
And a jumbo loan is is more of a it's considered like a non-conforming. Every state has a non-conforming loan limit, and for
Mm-hmm.
North Carolina, it's anything over $766,000 is
Okay.
considered like a jumbo loan. So
Okay.
what that is.
And I know to get finance for those loans, it's a little bit harder, or we wouldn't say harder, but you would need more, I guess, a little bit more information to get qualified for those loans.
Yeah, they are more strict as far as the guidelines go. So the credit score is going to be a little bit higher. The reserves, so like your savings balance, has to be a little bit better, like 3 to 6 months reserves. You're going to have a lower debt to income ratio threshold. So
Okay.
yeah, there's definitely some more like check boxes you got to go through.
Okay. It's all good information. Another question: how can self-employed buyers qualify for a loan?
Self-employed buyers.
Yes.
Um,
And maybe it might be a little bit easier to separate, I guess, your more conventional buyers that come in with um, the W two, and then you have the 1099. So, what would be the difference? What would you be looking at?
yeah, I mean, self-employed borrowers technically would have to, like, we would usually take 2 years of your tax returns and average the 2 years.
Hmm.
Sometimes we can get away with just using your last year's worth, but that's for people that
Okay.
have been in the same business for 5 years.
Okay.
Um, but typically, it's 2 years tax returns. We average that. The biggest thing with self-employed borrowers is that a lot of times you're going to be technically making more than what you're reporting on your tax return. So, um, a lot of times people will think that they can qualify for more, even though we have to use what's off the tax returns, and it might be a lower income amount. Um,
Right.
that if it doesn't work, there are other options as far as non-traditional type of loans that a lot of self-employed borrowers do use, like bank statement loans, and that's where
Mhm.
we would take like the last 12 months of your bank statements and use the deposits as considered as like income.
Okay.
Or if it's to buy an investment property, there's a loan called DSCR where we take the actual rental income that you're going to get from the subject property and use that
Mhm.
as your income.
Okay.
Um, so there's all sorts of different loan programs that you can kind of look at. Um, they might not be like the standard traditional type of loan, but again, it doesn't make it so you're not going to be qualified for a loan. So,
Okay. Just another route that you would take in order to get qualified. Okay.
yep, exactly.
Um, Another question: is it always good to put the closing costs inside the loan, or will it hurt you in the long run?
It kind of just depends on your goal, which is, one of those things we talk about on an initial call as far as, um, how long are you going to be in the house? Does it make sense to you now? Like, even with it, when it comes to like down payment assistance, does it make sense to have that, extra, like the higher loan to value? Um, and I always say that, nobody can predict the future, but our area in the Raleigh Durham area, I mean, the amount of appreciation here is pretty nice. So it's
Okay.
unlikely that you're going to be like in the hole when you come, go to sell it or whatever. But those are kind of things that we kind of talk about and determine based on like your goals and wants and needs, and everybody's a little bit different.
Yeah, that makes sense. Um, Someone chimed in. I'm interested in buying an investment home. Will there be a different process for multiple properties?
Multiple properties, like buying multiple homes or multiple units.
Yeah.
I mean, if you're buying multiple homes, then it's just multiple mortgage loans, so that wouldn't necessarily hurt you. If you're talking about units specifically, it would have to be a 1 to 4 unit, and
Hmm.
then anything over 4 units is considered commercial.
Okay. I think we have one more question. If a couple is unmarried, can they both be on the loan for FHA?
FHA you can. VA only allows spouse. If it's a non-spouse, there is kind of a loophole, but it's depends on how much you put down to. It's usually going to be a larger down payment, or not usually, it will be a larger down payment. And a lot of times they don't qualify for that, as far as like checking all the boxes to be a non-spouse. So 9 out of 10 times, if it's a VA, it's going to be a married couple.
Okay.
And they don't even allow an unmarried couple to be on the title like most
Oh,
ones.
really? I had a client, and he was trying to explain his situation, but I guess so. They both can be on the loan, but they can't be on the title. Is that right?
The the spouses can be, but if it's a spouse and non-spouse,
Hmm.
then they can't be on the loan together for
Wow.
VA or the title.
Wow.
Yeah.
Um, can my parents help me with the down payment? That's a good
Yeah.
one. Yeah. Yeah.
Yes, we get a lot of what we call gift funds, and a lot of times that's from the parents. It depends on the loan type and stuff, but most of them, you can use the full down payment requirement from gift funds.
Okay. Uh,
And
the
it's an
difference.
easy process too for gift funds. A lot of people think it's going to be too complicated, but honestly, like we don't get funds until they go under contract. So it's not like you have to get them ahead of time. And the parent or whoever's gifting the funds sends it directly to the closing attorney. So it doesn't like swap hands with anybody. And then we send a letter for them to sign. So it's a super easy process.
Oh, nice. Okay. Um, as far as the loan is concerned, what about adjustable rates versus like your standard rates? I guess I'm asking right.
Yeah,
Fixed rates.
yeah, and most people I talk to do not want an adjustable rate because they don't want to be surprised in the future. Obviously, well, not obviously, but there are caps to how much the rate can increase when it comes time for the adjustment.
Yeah.
Um, but in some cases, I would say credit unions would be the best with the arms, the adjustable rates. But if you're going to deal with like a retail lender like myself or just a normal mortgage loan officer, it's going to be a 30-year fixed or a 15-year fixed, majority of the time.
Okay, with the adjustable rates, how does that work? Because I know they can start at a certain percentage or a certain rate, and then they can come down or they can go up. And what is the time frame like? What does the time frame look like for those type of rates?
Yeah, so there's different terms. So there's usually the most popular ones are 5 year or 10 year, or
Okay.
there's actually 7 year too. And so when that after 5 years you've been in that mortgage loan, then your time where the rate will adjust based on that current market's
Hmm.
what's the going rate then.
Okay.
And when you initially got the loan, you're going to get told like there's a cap for like, okay, it can only go up or down 1% or whatever the terms are.
Mhm.
So it's super important to know what those are before you close.
Okay.
And you can always refinance. So I have refinanced a lot of people that want to get out of an ARM into
Okay.
a fixed rate.
Does that change anything once they get out of the adjustable rate whenever they go to a fixed rate?
Nope, we'll just pay that loan off and then they're set in that fixed rate, whatever we locked them in for that new mortgage loan.
New mortgage? Okay, nice. That's pretty easy. Someone chimed in. How does applying joint with my spouse affect our loan and our credit or income difference?
So, for a joint loan, we are going to look at your three credit scores for each credit bureau, and then we'll take the middle one. So, um, if there's two people on the loan, regardless of whether it's a spouse or not, we're going to look at the middle score from each borrower, and then we're going to take the lower of the middle. So essentially, if you have like an 800 credit score and your spouse or whoever else is on the loan with you has like a 600 credit score, we're going to look at the 600 as far as locking in your rate. And then again, that will affect your mortgage insurance if you're putting less than 20% down. So if you can qualify for just like the higher credit score person with just their income, then we would look at just removing that other person so we can use the higher credit score and get a better rate.
Okay, nice. That'll work out in people's favor.
Mm-hmm.
Doing. What is the lowest credit score someone can get financed for with a home?
There are some like non-traditional mortgage loans that allow like 500, but most are gonna be a minimum of 580 for
Okay.
the government, FHA, VA, and USDA. And then conventional loans, there's a minimum of 620.
Okay. Whenever they're coming in lower like that, with the lower credit score, what is the difference? What would they need to bring to the table to get them qualified?
Um, as far as cash,
Yeah. How much? What is? Yeah. What does that look like?
it will probably be a lower, sorry, a higher interest rate.
Okay.
But as far as like extra cash to close, it wouldn't necessarily change that factor. But
Okay.
with that said, there's also things that we can do called like a rapid rescore, where if there's like if you could pay off a credit card now and we can rescore your credit immediately and increase that and then get you into a better rate, then those are some things that we can look at doing as well.
Okay. I had a client that was looking to purchase a home, but they had a couple things that they were married, so they had a couple things they had to work on, and so yeah, the mortgage lender at the time they went ahead and did a rapid rescore, and it looked really good for them. It helped them out significantly. So yeah, I get what you're saying.
Mhm. Yep.
Um, yeah, is there anything that you recommend for people that because I know a lot of people are saying or they're nervous about coming to talk to a lender because they don't their credit. So I was
Yeah, that's like
bringing
one of
awareness.
the biggest things that I
Yeah.
get pushback from if they don't want to submit an application. But um, one thing is for me, I obviously can't speak for all lenders, but I always do a soft credit pull so it doesn't affect your credit. Because a lot of times when it's a hard inquiry, yeah, it can ding your score like a
Mhm.
couple points or whatever it is. And initially, we just do a soft credit pull. That still gives us a score and that still gives us your debt so we can calculate what we need and give you
Okay.
a true pre-approval. But it doesn't hit you with a hard inquiry. We would
Okay.
do that once you're under contract or, for whatever other circumstance we discuss. But initially for that pre-approval, we just do a soft pull.
Okay. so that therefore people are not alarmed and they understand that they can see what they have going on without
Mhm.
going over the edge, basically.
Yeah, and it just makes sense because then they'll know you don't, even if you think you need to improve your credit, you can
Mhm.
still get me to look at everything and tell you where you're at now and where you can continue to work to get to an even better place.
Yeah, yeah, that makes sense. And you guys, where you specifically, you look at it's not just the credit, but you look at the profile, right? It's a whole collection of things that kind of makes up what we're looking at. As
Hmm.
okay,
Yeah, and it depends on the loan program, but for the most part, we have credit, assets, and income are the three, biggies as far as checking those boxes and making sure that everything makes sense there.
okay. Um, question came in. What are the options to avoid PMI?
Um, put 20% down. No,
Come
but
in with
there
a little
are
change.
there are things called lender paid PMI. So you essentially have a higher interest rate
Okay.
to avoid that, or there's single premium. So basically, you pay the mortgage insurance up front at closing, and then it's not monthly.
Okay.
But those are two things that people don't necessarily do right now, um, because if you refinance before it makes sense, like break even
Mhm.
number makes sense, then essentially you could have just, lost a lot of money up front if you're going to refinance in, X amount of
Okay.
time. And that's one of those things that we can calculate to see if it would make sense or not. A lot of times people were doing that, especially the single premium, to kind of get it out of the way
Mhm.
if when rates were like, 3% and they weren't probably going to refinance ever.
Okay. Yeah. So not thinking about it long term can kind of hurt you if you're not careful.
Yep.
Yeah. We're just gonna do like probably two or three more questions because you've been great and you've been like just hitting it every bullet point. So I'm loving it. Thank you. I appreciate you so
Of
much.
course.
Another question is: can student loans prevent someone from qualifying?
I mean, yeah, they could, but just like any other debt, it just depends on how much they are and that sort of thing. It's going to go into your debt to income ratio,
Okay.
but we can either, if they're like, especially if they're deferred, like a lot of
Hmm.
schools are, we calculate it based on the balance.
Okay.
And we can either do 1% or a 0.5%. And again, it depends on the loan program, but um, if that is too high and it's affecting their qualifications, then another thing we can do is get them to look at like, income based payment, repayment, and they go through
Mhm.
their student loan company to figure that out as far as their payments go, if that makes their actual payment less than the 1%, 0.5% that we're calculating.
Okay.
There's ways around it.
Okay. Um, we'll do two more questions, then I'll let you go. What's the best way to prepare financially before applying?
Say that again, sorry.
What's the best way to prepare financially before buying?
Talk to me and then we can do an application and I can look at your whole profile and then we'll discuss all of the things.
Okay.
Um, it's really hard to like say exactly because everybody's an individual person and it's all unique. So you might think you need to do something and you're golden right now.
Okay.
Or you may think you're good to go and you want to put in an offer in and you find the dream house and you try to get a pre-approval the same day and your world is
It's
shattered
not
because
working.
you have to do
Yeah.
something
Start finding out.
whatever. So
Yeah.
again, it's never too early to have that conversation.
Okay. It is medical debt looked at for debt to income ratio?
No. um,
Okay.
I'm assuming they're saying medical collections.
Okay.
which can show up on your credit report, and we don't calculate those towards your debt to income ratio. No.
Okay.
Now, if there's some way that if it's paid off, collection in general, that is
Mhm.
too, like not even necessarily medical, but sometimes it'll affect your credit score. And so we look at those things, and that's one of those things that I go over on the pre-approval call after your loan application's been submitted, and we can kind of go over all the details
Mhm.
about like your credit report in general and that sort of thing too, because um, it's very specific.
Okay. And the last question of the day, Allie, how can we get in contact with you?
Follow me on Allie Fry. Allie
Okay.
Lee Fry. Allie Lee Fry. Yep.
Allie,
Follow my
yeah, I was looking
Instagram.
for you. I was looking for your hashtag, and I came across it. It was all smiles, so I was like, oh, look at Allie. All right, Allie. Well, I appreciate you chiming in and just
Thanks
really
for having me.
yeah, awareness, man. It really pays off. So I appreciate you just helping
Yeah.
us out,
I
helping us through.
appreciate you.
Yeah, you're welcome, Allie. So maybe we'll do this again
Yeah.
soon. Get some different questions. We'll be
Anytime.
prepared. Obviously.
Yeah.
Yeah.
I'll actually get on when you need me to get on.
Like I said, I
Technical
had to check it out too.
difficulties.
So. Right, right. It's all good. I appreciate your time, though. I appreciate you helping me out.
Thank you. Talk
All right,
soon.
Allie, I'll check you later.
Okay,
All right.
bye.
Bye.